So we first have to find out what the new equilibrium price of the stock will be after the repurchase. Since the investors anticipate the repurchase, the firm will have to buy the stock at the new price. To find the new price, we have to find the value of the company after it issues the $3 million of debt at 6% interest. So EBIT, earnings before interest and taxes, is given as $800,000. The tax rate is 40%, and the new rate of return on equity is 12%. All of that's given. So the value of the stock is, we want to use this equation for the value of the stock. It's EBIT minus big D is the amount of debt, K sub D is the interest on debt, so that whole expression, D times K sub D, is equal to our interest expense. We subtract that from EBIT and we multiply it by 1 minus the tax rate, so it's the after-tax rate on that. And then we divide that by the rate of return on equity, R sub S. So we input our numbers. EBIT is $800,000, the debt is $3 million, and the rate of return, the cost of debt, is 6%. The tax rate is 40%, and the rate of return on equity is 12%. This gives us a value for our stock equal to $3,100,000. Since there is $3 million of debt, the total value of the firm equals the value of the stock plus the value of the debt. Well, we just found the value of the stock is $3.1 million. We have $3 million of debt, so the value of our firm equals $6.1 million. We're also told that the firm will buy back $1 million of existing debt. So we must subtract this from the value of the company, because the $6.1 million would be what the firm is worth if it left the existing debt outstanding, if it left it as part of its company. But it's buying it back, so it has to pay $1 million from this value, so we need to subtract it to find what it's really worth. And so we take the 6.1 million minus 1 million, that gives us 5.1 million. That's going to be the new value of the company. And with 100,000 shares outstanding, the new price, what the investors are going to value on the company on a per share basis based on these new decisions to issue debt and buy back stock, is going to be that $5.1 million that they value it at, divided by the total amount of shares outstanding right now, 100,000. So this goes back to the fact that the investors are anticipating this firm's decision to buy back some of its shares. We found the new value equal to 5.1 million after we subtracted that 1 million. We're dividing it by the amount of shares now, which is 100,000. That gives us a price per share equal to $51. Well, the firm is using $2 million of the new $3 million of debt that it issued to buy back the stock that it has, but it has to pay the $51 per share, again, because the investors are anticipating this decision. Remember, the other $1 million of the $3 million of debt that it issued went to buying back $1 million of the old debt. So we're left with $2 million of debt that the firm is going to spend on shares at a price of $51 per share. That means they're going to be able to buy back about 39,216 shares. We just get that by dividing the $2 million by the price per share of $51. So they're going to buy back 39,216 shares. Well, originally there were 100,000 shares, so what that leaves remaining is 100,000 minus the 39,000, means there's going to be 60,784 shares outstanding. Now remember, we're looking for the earnings per share. The earnings per share is net income on a per share basis. It's net income divided by the total number of shares outstanding. So we have the total number of shares outstanding now. After the purchase, we found that to be 60,000. We need to find the net income. So to find the net income, we've done this all semester. We start with the EBIT and we subtract the interest on our new debt. So our EBIT is $800,000. The interest expense on the new $3 million worth of debt is 6% is the interest rate, times the $3 million of debt gives us $180,000 of interest expense. We subtract that from EBIT, that leaves us with the earnings before taxes equal to $620,000. Now we want to take out taxes. Start with an EBIT of $620,000. The taxes is the tax rate of 40% times this EBT, earnings before taxes of $620,000, gives us total tax expense equal to $248,000, which leaves us with a net income of $372,000. So we can find the earnings per share. We have all the information we need. It's net income divided by the total number of shares outstanding, or $372,000 divided by 60,784 shares leaves us with an earnings per share equal to $6.12.